golf, you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now, that can be really expensive, cost thousands of dollars, but I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro, Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
The stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money's coming to me. Money sets me free. I'm a money magnet. Money's coming to me.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network. With your host, Phil Grande.
And welcome to Phil's Gang, my podcast for October 2nd, 2025. Thank you for joining me. I'm going to give you insights on the stock market that I hope no one else can do. I've only been doing this now for about 48 years, so I know a little bit about the market. In fact, my shoes are older than most of the people advising you what to do with stocks. Anyways, what gets me grumpy is when I don't have my stinger. Give me my stinger up, Willie, if you could. You know, there's a reason why gold is doing so amazingly well. There's a reason that central banks have been purchasing so much gold. They just from January, I'm talking about just January, they've been purchasing 18 tons of gold. 18 tons. That's got to tell you something. Here, I got that. 18 tons of gold. I mean, that's huge. I mean, that's a message. They're sending a message. I mean, something's wrong. That's what gold means. When you got gold going up like that, it's just, something is wrong in your market, in your economy. But remember, the market and the economy, two separate things. But that's a lot of gold. So gold itself is up 47%, but the miners is where you should have been. We're up in the miners 121%. 121%. Miners are up 121%. We're up probably about, I think we're up about 70 or 68%, something like that. We bought GDX early. Matter of fact, I said in January, the new year started, I said, let me tell you, we're going to make all our money this year, gang. We're going to make it in gold miners. Because why? Because gold miners tell you what's going on in the economy. Something's wrong. It always tells you the truth. And when you start seeing these central banks, I mean, my God, buying all this gold. And then you need the miners to get the gold out. That's what you got to do. You got to stay with the miners because our miners are up 121%. 121%, because you got to get the gold out of the ground. So people always say, should I have gold or should I have the miners? Always go to the miners. Always go to the miners. You make much more money because it's real companies, real earnings, real labor, real people. You always make more money with miners than holding a slab of gold. But gold is going up. Gold is going to keep going up like a rocket because of the uncertainty. These central banks around the world and smart investors, the smart money, the institutions, by God, the big institutions, I'm talking about the banks. I'm talking about the hedge funds, the pension funds, the mutual funds. I'm talking about the the biggest banks, the 5 biggest banks. They're called smart money. They are buying a tremendous amount of gold, and because they see what's coming. We have overall job losses. We just got the numbers, 32,000. We just dropped 32,000 jobs. Energy jobs have dropped 30%. These are recent numbers. Manufacturing bankruptcies are up 67% year to date. Manufacturing bankruptcies, 67%. And manufacturing jobs is now in its 7th consecutive month of slashing. Mostly full-time jobs. Now think about that. That's why the bankruptcies are up 67%. But what do we hear every day? We hear from these knuckleheads lies every day about how great the economy is. When I hear this just drives me out of my mind.
Yes, the economy is strong, stronger than probably even we thought.
That's unbelievable, isn't it? I mean, it's just nuts.
Companies are strong.
Companies are strong. How can they be this strong? When manufacturing bankruptcies are up 67%. That's not a company? What's it, a lollipop? What are you, nuts? So, and what they do, which is really bad, this is what they preach every day, how strong the economy is. And then they show you the stock market. This is what gets me. If you look at the S&P, this is what really gets me. If you go and look at our S&P 500, let me pop it up here for you, the S&P. If we go back to February, okay, of 2025, let's see, wait a minute. Yeah, February 2025. And the market dropped 20% to that low of April. Now, why was the market dropping? What was going on? Because the institutional investors, now these are your pension funds, mutual funds, hedge funds, banks, they were dumping tech stocks and semiconductor stocks. Tech and semis, they were dumping them left and right, huge, and they're still dumping it. So then you got to ask, well, wait a minute. From April, the market shoots up about 30% to where we are today. But guess what? There's still the institutional investor. By the way, remember what the institutional investor is. The institutional investor contributes 80% of the action in the market. 80% of the volume is institutions. So they are buying gold like crazy, and they're dumping their stocks, the tech stocks, and the semiconductors. They're dumping them left and right. So one's going to say, well, then why is the market going up? Because they play a game. Stock buybacks. That started in 2008. Remember, we talked about this yesterday. Up to 2008, for over 100 years, more than that, earnings and profits was the mother's milk of the stock market. Earnings is the income you generate from your business. Profits is what's left after you pay your expenses. Everybody worked on earnings and profits. When you get your earnings, come from sales, and that pushes up. When you get good sales, your earnings will go up, and that pushes up your stock price. But you got to have earnings first. Because again, it's the income that you're generating from businesses. When you get your income, and then you pay all your expenses, you got your profits, and bam, earnings go up first, pushes your stock price up. This is what they've always done. They always fought for great earnings. It was the mother's milk of the stock market. That all changed in 2008 when the stock market crashed in 2008. Actually, 2001, the dot-com, but it really got rolling in 2008. They decided, let's play a game here. What we can do is we can fake everybody out, and we will fake out the retail investor. Now, get what they did. This is pretty interesting. if you look at a chart, let me see if I can get that chart up. I thought I had it here. Let me see if I can find it. This is an interesting chart right here. No? Let me grab my chart here for you. Okay, I'll pop it up here. All right. This is it right here, I believe. There it is. Okay. So again, what's happened is when the dot-com crash hit, that was 2001. And then we had the housing financial crash, 2008. So they decided then, we got to do something because like the 2008 crash, they lost $12 trillion. Wall Street, $12 trillion. They want to get that money back, but they didn't want to take the time to do business investment and then after the business investment, you got to increase productivity, increase sales. All that takes time, takes years and years. They wanted their money back right away, right? So that's when they came up with a scheme to do a stock buyback. So the big institutions, and here's how it works. This is what they do. So they threw out the window. You don't need profits anymore. You don't need earnings anymore to have your stock price go up. You can have your stock price go up without generating income from the business. You can have your earnings going up without generating, again, business. You can have your profits going up. You can have profits going up without paying your bills. All you have to do is keep reducing the number of shares. So every time the big institutions were dumping like between February and April 2025, all the big institutions were dumping tech and semis, and the market was going down. So now they said, well, we got to rally this back up. How do we do it? Because we're in real trouble here. They said, well, let's just do more stock buybacks. So what they did, if you take a look at this column here, this is your dollars, what your shares are, the dollars. Over here is the amount of shares. So this is how they do it. Let's say your stock, you have 100,000 shares, okay? Your company has 100,000 shares, your company X. So you see the big institutions now are dumping your stock. They're dumping your tech stock. They're dumping your tech, your semi stock. So you, as the CEO, going, I'm going to go buy that stock. I'm going to go buy that stock back. So when they buy the stock back, remember, it went from 100,000 shares down to 90,000. That's it. That's the number of shares outstanding. So when they buy that stock back, you reduce your shares by 100,000 to 90,000. So if you have less shares outstanding, once you buy your share back, you have less shares outstanding for people to trade. That means your stock price went from $20 to $40 because you reduce the amount of outstanding shares your company has to trade from 100,000 to 90,000. Now the market goes, now that your stock, the big institutions who contribute 80% of the action, 80% of the value, dumping your stocks again. The CEO goes, buys the stock back. And by buying that stock back, now that 100,000 shares, we now have outstanding, instead of 90,000 shares, because he's buying the shares back. Remember, he's going to buy them back. Now we got only 80,000 shares outstanding to trade because he bought them back. But the stock now went from $40 to $80. Then it happens again. Instead of having 100,000 shares, we dropped to 90,000 shares outstanding, to 80,000 shares outstanding, to 70,000, finally to 60,000. So from 100,000 shares down to 60,000, our stock price went from $20 to $150. But guess what? We have no increase in sales. We have no income being really increase in income generated. We have no income being generated. We have no earnings. Our earnings aren't going up. But by doing that, it can push the stock price up. So no more do you need the mother's milk. of the stock industry. No more do you need earnings or profits. You need to just do stock buybacks. Okay, where do they get that money for the stock buybacks? They get it from the Federal Reserve. How's that done? The Federal Reserve, Powell, calls the Treasury Department and tells them to print all this money. They send it over to Powell. Powell takes the money, gives it to the banks, the banks take it and loan it to the CEO so he can keep on buying his own shares to keep reducing the shares down so the stock price goes up without earnings and profits. But here's the real hit right here. This is how smart Wall Street is. They need a sucker. They need a sucker. So they're going to suck in who? The retail investor. They call them the tourist investor. The difference between the retail investor and the tourist investor. The retail investor is curious. The retail investor wants to learn, wants to make money, wants to, they want to know how everything works. The tourist is a pure gambler. So Wall Street makes sure there's enough money that they can lend to him, called margin account, so they can borrow. What does that do? It's like giving a 2-year-old a loaded gun. We'll talk about that when we get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
What does it take to be a successful investor in the stock market? Developing your skills and learning from an expert like Phil Grande and philsgang.com.
It doesn't have to be hard or complicated to learn how to invest in stocks properly. It's like anything else. You're going to golf, or you're going to learn how to play tennis, ski. You need to be with someone, learn off of them, one-on-one. Now that can be really expensive, cost thousands of dollars, but I have a program that you can join for 10 days free.
Go to philsgang.com and sign up for a free 10-day trial. Phil Grande has developed tools to teach you how to invest in stocks properly. Not only when to buy stocks, but how to sell stocks short.
85% of people in the market lose money. Get out of that group by just joining Phil's gang.
Now you can learn to invest like a pro with a pro. Phil Grande. Take advantage of this special offer for a free 10-day trial at philsgang.com.
Try it. 10 days free.
That's philsgang.com.
philsgang.com.
Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
And welcome back. We're talking about stock buybacks, and they used to be illegal. Because, right? I mean, think about it. It sounds illegal. If your stock can go from, if you can reduce the amount of shares you have from $90, from 90,000 shares to 60,000 shares, your stock can go up from $20 to $150 without profits or earnings. Now look at this. I'll read this to you. The Securities Exchange Act of 1934 made it unlawful, get this, to engage in transactions that created apparent active trading or a manipulated stock price to induce others to buy. There you go. And that's what happens. See, when the corporation, the CEO, buys his own shares back, the stock price goes up without having have profits or sales. Now, who are they trying to induce? They're trying to induce the tourist investor, the retail tourist investor, different from the retail investor. There's called the tourist retail investor. They're just gamblers. They don't want to learn anything. They're just like gamblers. So the whole idea is to induce the retail tourist investor to buy, and they do. They see the stock price going up. They see tech stocks. Geez, all these tech stocks were sold. Semis were sold between January, or February to April. The market dropped 20%. I'm going to buy on a dip. Look, they're going up. And they always, remember, they always get in after. They never get in at the right time. They always get in after, near the top. So how do they induce them? By artificially pushing that stock price up without an added sale. Now, Wall Street makes sure they give them plenty of money, the retail tourist investor, on a margin account so he can borrow. And he's in there buying stocks like crazy. Oh man, look, this is easy money. Look at the tech, look at Nvidia. Look, I'm just going to keep buying. And Wall Street sucks them in with margin accounts. Now all of a sudden, the smart money, like the institutions, they're out. They're dumping. They made a fortune. They're out. But who stays in? The retail investor, because he doesn't know any better. The retail tourist, he don't know any better. So they induced him to come in by creating action for the stock to go up without profits or earnings, to go up simply by cutting the amount of shares available. When the CEO stops buying his own shares back, what happens? He's going to stop buying his own shares back because the increased money supply stops. CEOs only can do this if they keep increasing the money supply, if the Fed keeps increasing the money supply. When that dries up, the stock price starts going down. Now, remember, they induced that retail investor, tourist, to come in and buy, and he's sitting up there. He bought the price at the all-time high. He's sitting there, thinks he's worth a fortune. All of a sudden, the stock price starts going down. He panics because he gets a call. Hey, Charlie, guess what? I need a check for 10 grand. You look at your margin account. You're upside down. I need 10 grand. The guy says, I don't have it. I'm losing money. Just sell my shares. Then the second guy does it. The third guy does it. All of a sudden, bang, you have your crash. So anybody that tells you it's a surprise, anybody on Wall Street who's supposed to have experience tells you they're surprised by a stock market crash, they're lying to you. No professional is surprised, because either it's always the same every time. The dollar's going up, that's going to screw you. And you're sitting there, especially with these tech stocks, overvalued, insane. I mean, they're priced to the moon, and the only reason why they're up is because they're doing stock buybacks instead of business investment. Crazy, isn't it? But so again, so there was you went to jail doing this. There was criminal penalties for companies conducting stock buybacks. But in 1982, Reagan changed all that. They got a law through, so now you can do stock buybacks. So stock buybacks is a way to drive the market. And who drives the market? Institutions, because they have 80% of the volume. They love it. So they control the direction of the market. But guess what? You can make a lot of money if you know what you're doing. First of all, you're going to know when that market is going to turn around and correct or crash, because what you look at is the margin accounts. All of a sudden, the margin accounts are in trouble. You're going to know that immediately. You're going to know them, and you're going to know that from watching the increased money supply shrink. So the increased money supply shrinks, the retail investor starts losing money, the margin accounts, you start seeing them blow up. Get ready, start selling, start shorting. That's the whole key. You got to know how to sell short. So who the hell ever wants to go back to an honest market? I mean, you make much more money when the market's not honest, when it's manipulated. And there's no bigger manipulation when you can move a stock up without generating additional income, or by, again, you don't have to worry about paying all your expenses to have a profit. It's just nuts. Gold, on the other hand, tells you something's wrong with the economy and with the stock market. The stock market and the economy is not the same, okay? Totally different. So now gold has been going up like a rocket, due to we got tremendous job losses. That all started with Biden with his fake 1.1 million jobs. Energy jobs since January have dropped 30%. Manufacturing bankruptcies have gone up 67% because manufacturing jobs are now in their 7th consecutive month of slashing full-time jobs. That's why manufacturing bankruptcies are up 67%. So, and it's going to get harder and harder to find a full-time job. Everything's gone from full-time to part-time to no time. And of course, we have a record amount of consumer filing bankruptcy, 24%. So again, what can cause a crash, remember, is a strong dollar. You got to keep your eye on that dollar. Now, I want to show you something about the dollar. You got to pay attention to this dollar because we can make a lot of money. Just like we made a bunch of money on the gold miners. And I told everybody in January, so that's where we're going to make our money this year. Now I'm going to show you something else. If you look at the dollar, now the dollar is ready. If you take a look at it, I'll pull it up for you if you don't have it, UUP. Look at the dollar. The dollar has been, if you go back to December 18th, 19th, okay, just go back there, all right? And look how the dollar dropped from $30.69 all the way down to 27, or actually down to about 27 bucks. But notice what's happening. The trend is changing. The pattern's changing. We're starting to consolidate. Look at this. If you take and draw a line right here and right here, look at the consolidation, how long it's been consolidating. And look at this. We got more buyers coming in than sellers. We're above the 50-day moving average. We're above the 25-day moving average. And look at our stochastic. Our red line has crossed yellow. We're in the sweet spot. So if this dollar can start moving up, and it looks like it's going to, because there's going to be a tremendous amount of short covering. Okay? Now don't forget what the institutions are doing right now. Okay? The institutions right now, they're sitting there every day trying to short the bond market. That's what they want to see, that bond market collapse, right? Because again, when you have your bond market, when you have the rising yields, the dollar's going to go up. Now, they've been pushing the yields down. You can see it. They're pushing the yields down. They're scared to death because when those yields turn around and they start going up, the dollar's going to go up. And when the dollar goes up, all hell's going to break loose. And when the dollar gets stronger, that's real bad for tech, gold, crypto. You got to know how to sell short. And you can see we're setting up for a rally that looks like a rally. Look at this. They've tested the lows here. Okay, let me use for a low here. Let me see if I get this right. Okay, let me get the low here. The average low has been around, they tested the low around 26.97, about 3 different times. They couldn't break through it. So there's money coming in. Everybody made a ton of money shorting the dollar. Now they're going to try, they got to take those, let's say you made $10,000 shorting the dollar. Well, you haven't made any money because you have to buy it. You got to buy it first, okay? So when they after they short it, they got to buy their position back, and then all of a sudden, bam, the dollar will take off, killing the stock market. But we already know the stock market's in trouble. We got gold telling us something's wrong with the market, something's wrong with the economy. So we know that. So it's not a surprise. So you keep your eye on that dollar. If that dollar gets to about $28, you're going to see a big correction, okay, in this market. Everything's going to break loose, believe me. Your crypto is going to get tanked, your gold. And that's why you need to learn to short. The reason why retail investors, 90% of them lose money in the market, this has taken over a 50-year period. In the past 50 years, 90% lose money. They always lose money in their 401k. They think they're rich, and then they don't get out of their 401k. They don't cash it in. When you remember in 2001, how much money you lost in your 401k? Remember how much money you lost in your 401k back in 2008? 2020, and you know how long it takes to get that money back? And it's a grind. It's a grind. Years. And that's why when we had the 2008 crash, that's why Wall Street said, we don't want to go through that grind. We want to make our $12 trillion we lost. We want to make it back now within 3 or 4 months. We don't want to go through this. So Obama, we're going to put you in office, and they did. We'll fund you, get you in office, and you got to help us, okay, with whoever's going to be your head of the Fed, that he's going to be on our side to do stock buybacks and to do QE, print and go buy. First of all, the Fed dropped its interest rates to zero. Then they print all this money, and then they go buy the 10-year Treasury, so the yield goes down to match the low yield with the Fed. And that's how the whole rally started. And then they said, well, we'll do these stock buybacks for about 90 days and stop. It's now been, 15 years. So we got the biggest bubble in history. But it doesn't mean to get out right now. You keep following the money. And that's another thing I did. I built a chart that shows that you can just follow the money, follow the pricing on your stock. You know if money's going in or money's going out. Now, a lot of people have tried to copy me, okay? And they got these ridiculous products out there, okay, that are a joke, okay? But our chart is the original chart. Over 225,000 people have used this chart because it tells you where your money's going. Is it going in or going out? So again, watch that dollar, put up UUP, and always remember, when the dollar goes up, the yields are going to go up, okay? And vice versa. So again, we had that 20% crash in April. They're dumping tech stocks and semis. The fastest pace in 5 years. Valuations were too high, too much uncertainty in overall market, the economy, there's no confidence. So again, the institutions at the end of April, they still kept dumping. They're still dumping. But you don't see it in the market because the Federal Reserve makes sure that we have increased the money supply by so much the CEOs can borrow all this money and keep buying their own shares back, pushing their stock up by lowering the amount of shares outstanding to be traded. So instead of having 100,000 shares to trade out there during the day, if they drop it down to 90,000, stock price goes up without profits. Join my gang, philsgang.com, free for 10 days. We'll show you how to do this and maneuver this. You got to be ready.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.